All right, let's talk about something every single one of us has probably thought about, maybe even obsessed over as an investor. It's this magnetic pull to buy an asset at its absolute, perfect, rock-bottom price. Well, today we're going to pull back the curtain and show why that very obsession might just be one of the biggest traps in the investing world.
I mean, seriously, how many times have you heard this? Maybe you've even said it yourself. You know, things like, oh, if Bitcoin ever hits $4,000, I'm going full port. Or, man, if Nvidia drops below $80, I'm going all in. You see these kinds of bold statements all over the place. It's this deep human desire to feel like you've absolutely nailed the timing.
But here's the big question we're going to dig into. Is this laser focus on finding the perfect bottom actually the smartest way to invest? Or is it just a psychological game we play with ourselves, one that actually keeps most people stuck on the sidelines while the real money is being made?
Okay, let's really get into the nitty-gritty of this. We're calling this whole thing the bottom fishing trap. Because, as you're about to see, what sounds like a genius-level move is often a deeply flawed strategy that can really work against you. So just so we're all on the same page, what exactly is bottom fishing? Well, it's pretty much what it sounds like. It's the hunt, the quest, for that one single mythical lowest price during a crash, all in the hope of squeezing out the absolute maximum return. On paper, it sounds like the ultimate win, right?
But here's the core flaw, the fundamental contradiction in the logic. If you've done your homework and you genuinely believe an asset is going to be worth a ton more in the future, why would you be sitting there with zero exposure, just waiting for a slightly better price? The whole idea kind of falls apart when you think about it.
And you know, this isn't just about bad logic or math. It's about something much deeper: human psychology. It turns out that this desire for perfection, it almost always leads to total paralysis.
And this just perfectly illustrates the huge gap between the dream and what actually happens. The dream is beautiful, right? You wait patiently, you time it perfectly, you catch the bottom, and you look like a genius. But the reality for most people, the rally starts and they're left behind. Or even worse, the price does hit their magic number, but by then the news is so terrifying that they're too scared to actually pull the trigger. And just like that, they miss the best opportunities entirely. Let's make this super concrete with a quick example. Let's say you've done the research and you really believe an asset is worth, say, $100. Right now, today, it's trading for just 20 bucks. That is a potential 5x return on your investment staring you right in the face. So this is the million-dollar question. Why on earth would you risk missing out on that massive, clear-as-day 5x win just for the tiny chance of maybe turning it into a 6x or 7x gain? You're basically risking a very likely home run for an incredibly unlikely grand slam.
And that's the psychological trap in action. If you look at the data, most people who set these super low buy prices, they never actually buy. And the reason is simple. They don't have a real conviction in the asset's value. As the market falls, the news gets worse, the headlines get scarier, and fear takes over right when confidence should be at its highest.
Okay, to really drive this point home, let's strip away all the complicated market jargon. Forget about stocks, forget about crypto. Let's just use a super simple analogy that anyone can understand. Let's talk about the 5-cent apple.
So, just imagine you know for a fact that a good, fresh apple is worth about $3. That's its real intrinsic value. Now, you walk by a market stall and they're selling that exact same apple for just 5 cents. Do you buy it? Of course you do. It's a fantastic deal. Then, the next day, the owner panics and drops the price to 2 cents. What do? Well, you should be thrilled to buy even more. And this brings us to the most important question in this whole analogy. Just because the price dropped to 2 cents later, does that mean your original decision to buy a $3 apple for 5 cents was a mistake?
The answer is a simple, resounding no. Because look, a good deal is a good deal, period. The market offering you an even better deal later on doesn't make your first smart decision wrong. It just means the market got even crazier, giving you yet another amazing opportunity. Okay, so if that's the mindset, how do we actually turn this understanding into a real strategy? Let's build a simple playbook for what a rational investor should do. Now, I can already hear what some of you are thinking. Okay, this all sounds great, but I'm already full port. I'm all in. I don't have any cash left to buy that 2-cent apple. It's a super common problem, so let's tackle it right now. Here's the critical mindset shift. You are never truly full. What feels like an investment problem is actually a cash flow problem. See, your biggest asset is your human capital, your ability to get up every day and earn a living. Your next paycheck, that's new capital.
And hey, if you don't have an active income, a part of your portfolio should be in assets that generate yield. That way, your money is working for you, creating new cash to invest. You are never, ever truly out of the game.
So this all boils down to a new framework. It's just 4 simple steps. 1. Figure out what an asset is actually worth. 2. Buy it only when the price is way below that value. That's your margin of safety. 3. If the price drops more, see it as a better deal, an opportunity, not a mistake. And finally, step 4. Sell when the price goes above what it's truly worth. It's a system based on logic, not gut feelings. Let's wrap this up with one last big idea. And honestly, this could change the way you look at everything. Investing is not a competition. You have to play your own game.
And the difference is night and day. The bottom fisher is trying to compete with everyone else on the planet, trying to get a better price than millions of other people. It's stressful, and it's basically just gambling on luck. The value investor, though, they're playing their own game. The only question that matters is, did I get a good deal for myself? It's calm, it's logical, and it's based on discipline.
And this quote just says it all perfectly. As long as a trade you made was profitable and made sense for you, you've already won. You've succeeded. Trying to catch that exact bottom, that's not skill. That's usually just pure, blind luck. So I'll just leave you with this one last question to think about. What's your real goal here? Are you trying to get the absolute best price, competing against the entire world? Or are you just trying to make a good deal? They sound so similar, but as we've talked about today, they are worlds apart in how you think, how you act, and ultimately in the results you get.
Smash like and subscribe.